Today, we're going to discuss why the Fed is always in our head, especially right now. And we're talking about mortgages, so why are we talking about the Federal Reserve so much? Well, we're going to get into that. The Federal Reserve establishes their Fed fund rate. Now, the Fed fund rate establishes short-term borrowing costs. Part of the mechanics of how that works is the Federal Reserve actually lends money to banks. So banks will sometimes borrow money from the Federal Reserve. Now, when I say banks, I'm not just talking about your brick and mortar bank down the street or your large Chase, Bank of America, Wells Fargo, whatever it may be. I'm talking about those banks as well as the smaller banks. They all sometimes or routinely borrow money from the Fed, and the Fed sets that rate. Right now, their policy rate, the Fed fund rate, is at 4.25% to 4.5%. It's always within that margin. And with a Fed fund rate there, okay, 4.5 is that rate. So it's costing the bank that much money to take the money. And then the bank is going to lend out that money. So when they lend out that money, whether it's short term or long term, all they have right now is what that money's costing them. So they're going to build in what's called their margin on top of that. The bank needs to make money too. So you're going to see that these short-term borrowing costs have an impact, sometimes directly on lending, but sometimes based on the banks and how they're managing their balance sheet and their liabilities so that they can manage accordingly. If the money is costing more from the Fed and they rely heavily on the Fed, you're going to see the borrowing costs at those institutions go up. So that's a tangible direct impact. The 10-year Treasury yield is another factor that the Fed influences with these short-term borrowing costs. We've talked about bonds in the past very briefly. I'll just review. You can think of bonds as the government borrowing from investors, from American consumers, from anyone who's going to buy those bonds. The bonds are a promise to pay back the money at a fixed value at the end of the term. And then however that bond is purchased, however much money that bond is purchased for, dictates the yield of that bond. That's why we look at the Treasury yields every week. Looking at the bond market, this also is much more closely tied to interest rates because the 30-year fixed rate mortgage is pretty closely tied to the 10-year Treasury bond. The logic behind this is, even though you may be asking, oh, well, if I'm going to have a mortgage for 30 years, why are we not looking at a 30-year bond for that? And that is a great question. The common or conventional wisdom behind that was the fact that most Americans actually only stay in their home in around 5 to 8 years. And historically, that's been the turnover where people outgrow their home and have to move. So the mortgage rates for 30-year lending, because the trend of history was showing that those 30-year mortgages were not actually performing for 30 years, that debt would be refinanced. That debt would be paid off when the clients or the homeowners move to another home. Well, they're going to adjust the interest rate. So the interest rate's tied more closely to what we call the time horizon that the homeowner is expected to be in the home. So that's why the 10-year is the market indicator that we'll look to so closely for the 30-year fixed rate mortgage. The Fed also has a couple levers that they pull. The Federal Reserve is there, and they're meant to ensure a stable economy, a healthy economy, and when the economy moves in a direction like it did in 2022, where we saw inflation go up tremendously and very quickly, they needed to step in. So some of the levers that they pull are to increase that short-term borrowing cost to tamp down on the growth, which is meant to slow inflation. That being said, that was really, in my assessment, a little bit of a reaction to a long-standing policy that was more so in reaction to the 2008 financial crisis. That is a time where the Fed used something called quantitative easing. And quantitative easing, you may have heard about on the news. I want to break that down for you. So quantitative easing is a monetary policy tool that's used so that the central banks can stimulate economic growth and increase money supply. Now, the second half of that's the tough part, and that's part of the reason why inflation did go up so high. If we think back in 2008, the Fed dropped their policy rate, their Fed fund rate, to zero or near zero to help stimulate an economy that was in financial ruin, for lack of a better term. So quantitative easing is what they used. This means, number one, asset purchases. That means that the Federal Reserve is actually buying back large quantities of securities. Typically, we're talking about government bonds and mortgage-backed securities. When they step in as a buyer, that raises the price because they're a competitor in that marketplace. When they are a competitor in the marketplace, then the price goes up, the yield goes down. The yield is where interest rates lie. So when they step up, yield goes down, and that creates a lower lending environment. The second one, increasing money supply. If they are injecting money into the economy, the central bank is creating funds to purchase these securities. So it's a little bit of a double compounding effect with that. Then you have their actual Fed fund rate, as I was mentioning, where they lower their benchmark interest rate, and that creates a more affordability. And more affordability means people spend more money, and it stimulates the economy. All of these factors lead to economic stimulation, which is the last part, which is mostly the goal of what quantitative easing does. Now, we had from 2008, we had the great financial crisis, and the Fed used quantitative easing to lower mortgage rates and stimulate the economy, stabilize the economy. In doing so, they created a historically low interest rate environment. And that was an environment that persisted for the better part of a decade and a half. Only until 2019, 2018 did we start seeing mortgage rates start moving upward to what I would call a more healthy, balanced environment. Then the COVID-19 pandemic happened. And what happens? Well, we had another problem in the economy. So the Fed steps up and then they implement quantitative easing again. And they do the same thing that they did in 2008. But after you have a decade and a half of doing what you did in 2008 and then do it again, that makes it much more painful, and it creates this environment that we see that's a very difficult and complex situation to get out of. See also how sticky inflation has been since inflation went up so high. Now, bringing it closer to our current history here with the Fed, in 2022 to 2023, that's when their rate hike started. When inflation went up, just as they needed to stimulate the economy before when it was in trouble, well, when the economy was doing very, very well, but we had a high inflationary environment, the Fed needed to step up, increase their benchmark lending interest rate, and then start peeling back their money supply. They started peeling back how much they were going to be a buyer in the market for government-backed securities like bonds and mortgage-backed securities. So when they started pulling back, that created space in the marketplace for other buyers. And if that demand's not there, the yield goes up. Yield goes up, interest rates go up. So we can kind of get a sense now of how these things operate. And the reason why the situation that we find ourselves in is so complex and difficult to navigate out of from an economic policy standpoint. Now looking ahead. So now we just discussed everything about the Federal Reserve. We discussed how they've operated, what they do, and their tangible effect on the market and mortgage interest rates. Where we find ourselves now and what we just discussed earlier in the episode can make a little bit more sense. We are seeing that now the Fed is paying attention to the inflation data, paying attention to the job market, and they really do need to see inflation come down before they can start lowering their interest rate. This is where I'd like to highlight again. I mentioned it last week. It's so important to understand. We're still in a very volatile environment. The Federal Reserve, straight from the horse's mouth yesterday, Fed Chair Jerome Powell mentioned their consensus is that there's 2 rate cuts ahead based on the current economic climate and what they can forecast. 2 rate cuts. The market is expecting 3 rate cuts. It's not the same. As long as there is not harmony between these two things, we're going to be in a volatile environment. We can see interest rates go down. I can say just before I started recording this episode, I took a look at the bond market after I put them on my outline to report to you. Bond market's already reducing from where it was earlier this morning. So there's going to be more effects. And as people start to digest every single word that Fed Chair Jerome Powell said yesterday at his press conference and in his response to questions from reporters after his policy statement from the Federal Reserve. As a quick note, there were 2 governors that were reported out in the conversation yesterday that actually expected 3 rate cuts. So even though the Fed consensus is 2 cuts, there were a couple dissenters that believed that there could be 3 cuts this year. That being said, that wasn't the majority because the consensus was 2 cuts. So as long as these things continue to happen and the market has different expectations, we're volatile. Again, I'll reiterate, this is the opportunity time. Not to mention, we're almost in April. We are getting into squarely the spring market. As we go into the spring market, now is the perfect time, especially if interest rates are reducing, to refresh your pre-approval. If you were a prospective home buyer, if you're a real estate professional, this is the perfect opportunity for a reason to call, for a reason to chat and check in with your prospective buyers, the fence sitter sellers who were waiting for lower rates. We have another opportunity coming here. We don't know how long this opportunity will last, though. All it could take is another data point or another comment from someone on the Federal Reserve Board or further commentary from Fed Chair Jerome Powell. The markets can react negatively. So as long as we have what we have right now, it's a wonderful opportunity. And we're starting to see ourselves approaching lows of 2025 for our mortgage rates. All the more reason to get prepared and maybe get into the market and be as aggressive as you're comfortable with within your budget. So reach out to me if you want to revisit or if you'd like to have further conversation on that.